Hello, friends. Welcome to another episode of Weekend Investing Specials. This is a special episode backed by a lot of data and that delves into insights from the past market journey. So, this chart is a Sensex chart from 1979 till today, almost 45 years of span there. And, it just shows how the growth is virtually continuous and unstoppable. Anybody who's coming to the equity markets should be seeing this chart and have a long-term view towards the market. Now, you would have noticed that many a times in our interactions also when we have uh, monthly lives or other interactions, we keep telling you that you must keep a long term view. Now there is a reason for that. The primary reason is what is this data study will show you is that you need to be invested for the long term. And secondly, the very crazy kind of statistic that is available from, let's say, Association of Mutual Funds of India, or SEBI releases it, is that the average investor stays in the market in a particular instrument for only 18 months or less. So when the average investor will come in for 18 months or less, he or she, if by luck they have got the timing right, will make money in those 18 months. Otherwise, mostly they will lose money. There have been historical studies on this also. There is the classical example of Peter Lynch's fund, the Magellan Fund also, which had a fantastic run for almost more than a decade, clocking some 28% CAGR or somewhere near that. And yet, the average investor in that fund lost money because they were selling at the bottom, they were buying at the tops, coming in, coming out, putting in a lot of money at the tops, taking out a lot of money at the bottoms. All the kind of jugglery one can imagine is happening, and mostly with retail, because most retail investors cannot stay the long course. And that is the only thing that really makes money in the markets. I mean, I can tell you with my 30 years of experience, even if you don't have the best strategy, even if you don't have the best stocks, even if you don't have the best funds or small case or whatever it may be, but if you are consistent and you stay the long journey, you will still make decently good money. But if you try to, come in, go out, put in a lot of money at chunks at different points, which may be the tops of the markets, and then you get frustrated and you take out money at the bottoms, do all this kind of jugglery, more active management that is required, you end up with either sub market performance or just disaster. So just not doing anything silly, the runway is available for you to fly your plane on. Now, if you choose to just plainly follow that, you make money. If you don't do, then you don't make money. Let's get into the data for this uh, special. So these three dates are there: 1992, October 2022, and December 2007. So what is special about March 1992 to October 2002 to December 2007? And in this chart, you can see there's steep run till here, then you have a flattish market, then you have steep run, then flattish market, then a run forward. These 3 points are the combinations of a great past 5-year CAGR resulting in a post poor 5-year CAGR. So if the previous 5-year CAGR here was good, it was poor here. If this was poor here, it was good here. It was good here, then it was poor here, so on and so forth. So again, each point you had a 52% CAGR run for 5 years prior to this plateauing out, which had a minus 5% for the next 5 years. So not just what has happened in the past, but also try to absorb here what can happen in the future. So the markets can give you 52% CAGR in 5 years. It has happened in the past. There is no reason that it cannot happen in the future also. So five-year CAGR of 52% is enormous. I mean, you go from uh, I don't know how many times uh, over your base capital. Uh, and then you can also hit patches like this 5-year period where, for the next 5 years, you basically lost 5% each year. Uh, so that can also happen. Then there could be, a patch where you didn't do anything for 5 years or lost money for 5 years, but then the next 5 years was again 46% each year, CAGR. So a lot of folks who probably, would have gotten in towards the latter part of the bull run got frustrated in these 4 5 years, gotten out and missed this again. This is typically what will happen in most bull markets. And then again, December 2007 was peak. Those fence sitters who were sitting with FDs all this while, they would jump in at this point and saying that, oh, we cannot afford to have not have equity in our portfolio. Let's jump in. Dekhi jayegi. 2007. And then, next 5 years, zero returns. So again, you get frustrated, you get out, you say equity is not for me. My stars are not aligned. I'll go back to real estate, gold, FD, whatever. So this cycle has been continuously happening. And till 2009, from 1979, so about 30 years, there has been a good correlation between if the previous 5 years was good, the next 5 years was bad. If the previous 5 years was bad, the next 5 years was good. And you can see this in the data where the future 5-year CAGR and the previous 5-year CAGR is sort of contra. So, when future is high, the past was low. When the past is high, the past is high, the future is low. So it was a contra 5-year sort of cycle that was happening till 2008-9. And then, something changed. So, and you can see on the chart also, there was a significant amount of a sort of a run up, then flattish market run up, flattish market run up, and then it became somewhat smoother. Post 2008, something changed that was not seen earlier. So what happened after 2009 is that markets, you can say either markets matured or they became more consistent, and you did not see the kind of differential that was there in 5-year periods, consecutive 5-year periods uh, on the CAGR. So now you may attribute it to matured markets, or maybe 2008 onwards, the world changed, and the world changed to a point where central governments did not want too much volatility in stock prices or the markets to go boom bust. So they allowed money printing, they allowed a lot of QE, and all those kind of things happened, which allowed a lot of liquidity into the market. Whether our business cycle was good or not, whether economic cycle was good or not, liquidity was never too short. And that caused no major crashes to happen in the last uh, 15 odd years. I mean, COVID aside, which was a very sort of a extreme situation out of nowhere. Other than that, regular business cycles, economic cycles have not witnessed any extreme situation, because as soon as the market starts to give any signs of a recession or a slowdown, suddenly there is a pump up of stimulus that happens and it stabilizes. So the kind of moves that were there earlier sort of mellowed down in the last 15 years. So the difference between past and future 5-year CAGR, which used to be big earlier, really came off, and there was hardly too much variation left there. Now, for a particular 5-year CAGR range, what is the probability of the next future 5-year CAGR range from 84 to 2009? Let's look at some of this data. So this is the future returns on the y-axis, sorry, x-axis, and this is the past return. So you see the plot how it goes, that if the past returns were really poor for the last 5 years, you had some, great returns, uh, the probability of great returns happening here. On the contrary, if you had past fantastic years, some high probability years happening, then the future returns were very, very nominal from that perspective. So all that is sort of also brought out very nicely in the data that is available, that you will have some great years with poor outcome for the next 5 years, and poor years with great outcomes in the next 5 years, if that was to happen. But this was till 2009. Now, post 2009, this is where things will get interesting, is that it just consolidated into a very small sort of part of this entire matrix, that you know past performance of last 5 years was virtually limited to, you know -10 to +25%, and then the future performance also was limited to, let's say, minus somewhere near 0 to maybe like 20%. So your variability of the moves between the past and the future really, really have uh, come together, to the extent that in the past, if you had 5 years of negative returns, then you are 100% probability that you will make future returns in this range. Or if you had some nominal returns in the past, you have very good probability that you will be somewhere in this region right here. And this is basis, of course, 15 years of data, monthly data for the last 15 years, 5 years rolling CAGR return. So this is telling you that today's world is very different from the previous world. And now that, you know, uh, while there is no certainty that uh, any debacle cannot happen, but certainly if the control remains with the governments and central banks the way they have controlled it so far, it seems that this equation is not going to change anytime in the future. So the points that you need to really extract out of this data is that extreme past performance, both positive and negative, tends to be followed by significant reversals, reinforcing the cyclical natures of the market. So this, while the amplitude may have come down, but the directional part, that if you have some great 3, 4, 5 years, expect more mellowed down next 5 years in the next cycle. Or if it is reverse, that if you've had some really tough times in the last few years, you can really expect some great times in the next few years. Since 2010, the markets have become more consistent, more mature, more liquidity is available, so things have smoothened out, and the linear nature of the market continues on. There is no sort of metric of valuation or any other metric that is causing any major volatility. Even if markets are very on a valuation front extremely valued, they slow down a bit, but they never sort of crash anymore. I mean, because again, as soon as that event starts to happen, there are forces that come into play and provide liquidity. So while equity will always remain a riskier asset class than others, but this behavior of the market is causing more and more people to come to the markets, which is the good part, is that people are not so much afraid of the markets like they used to be a decade or two back. Like I remember when in 90s I started my business, there was a sense of, it was like a, if you are coming to the markets, it is like a gambling den, that you'll either make money or you lose all of it. That sort of view has somewhat changed. I wouldn't say fully, but somewhat changed, and SIPs and funds and small cases and all these new products are beginning to percolate quite deeply into the average household. The average household uh, savings have also gone up. The investments have also gone up towards the market. Pension funds are also now coming towards the market. The market is getting deeper and deeper as we go along. So that is a good sign. That is probably causing the stability of the market. Uh, the post 2011, except for COVID, rolling 5-year CAGR has been extremely consistent, around 11 to 12% mark, and that is giving a lot of confidence to newcomers as well as those who have been in the markets. And hence, a minimum 5-year view is something what you must keep in equities in any product. I'm saying not just small cases or mutual funds or PMS or whatever is that product. You must have a long term view, but that view should be combined with a strategy which is self correcting, self healing in nature. I mean, it should not be that I've bought a stock and now I'm going to wait for 10 years for it to perform. That is probably not the right strategy. The right strategy is that the strategy should be able to detect where I'm going wrong and course correct on the way, so that maybe you have to get some stocks out, maybe you have to get some stocks in, maybe you have to change the allocations, maybe you have to also have asset allocation around it. So a dynamic way of managing your portfolio, but with a longer term view of the allocation, that yes, I may be in a business or economic cycle that may not work for the next many years, but then if it doesn't work for the next many years, I'm almost assured that the next half a decade is going to be super phenomenal for me. So that kind of a knowledge, that you know even if the last few years have not been good, I still can really make up for that in the coming times, is something that will keep you planted. I can tell you my own experience that I think 2009, 10, 11, 12, post 2008, portfolios were not moving at all for almost 4 years. And, a lot of my investors gave up on the market. She said, what is the point? I mean, it's not even giving FD returns. I've wasted 4 years in this market. So this kind of historical behavior performance is already available for us to learn from, and hence we can be better investors learning from all this. I hope you like the content. Do let us know in the comments. Do please read the disclaimer as well. And I wish you all the best in your investing journeys. Do like and share these videos if you like them, and I'll see you in the next one. Bye bye.